Hello, everyone. Today on the final bar, we'll do our normal Monday routine, hitting the market from three directions: top-down macro, bottom-up stock picking, sector rotation as well. Overall, growth back in the driver's seat today. If you had any questions over the weekend about where the leadership is, days like today sort of confirm it's the FAANG stocks. It's the growthy sectors like communication services and technology pushing their way higher, dragging the NASDAQ up as well, while cyclicals certainly lagging behind. What does this mean for the remainder of this week? During this lighter holiday week before the 4th of July holiday. We'll look at all of those together. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny and very hot Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets together. I mentioned there's it's hot here. There's a record heat wave in the Pacific Northwest, Seattle and Portland reporting record heat. We're hitting about 108 degrees here at our house, and that's about 30 degrees higher than normal for this time of year. So a lot of people struggling. Luckily, for the most part, the StockCharts family hanging in there just fine. We're going to get through this as we have other things as well. The market overall certainly in resilient mode. And when you think about the leadership and growth, you can see the push higher on a day like today. The average growthy chart, the FAANG stocks, which we'll look at a little bit, the ARK Innovation Fund, Tesla, biotech stocks, even things like Generac and others, just in brilliant uptrends. You look at things like energy, and while they're not horribly broken, certainly feeling the weight of the movement away from that part of the market. You're seeing all in on growth, continuing to push higher. Can the market go higher, driven by growth? Apparently so, as the S&P pushing higher today. Now we have some great content coming up for you here on StockCharts TV, and particularly my show, The Final Bar. Tomorrow, we have Clint Cowles from TD Ameritrade coming to us from Minneapolis. Clint does a fantastic job breaking down the macro environment. It's always interesting to see how the charts relate to a lot of the things that he's seeing. On Wednesday, we'll take a break. Actually, no live show, but we'll have a great replay for you. On Thursday, July 1st, Grayson Rose, our own from StockCharts.com, he's going to be sharing with you some of the charts that are top of his mind. And then for Friday, we'll take that Friday show off for the long holiday weekend. Wish you all well for the 4th of July, and we'll see you back next Tuesday after the holiday weekend. Also, as a reminder, this coming Thursday, July 1st, I'll be doing a presentation at the Money Show Virtual Expo for ETF investing. My presentation is called 10 Questions ETF Investors Should Ask at Mid-Year. That's running the first at 2:10 p.m. Eastern. You can go to moneyshow.com if you'd like to sign up for that free event. Should be a lot of fun. I'd encourage you to check it out. Let's continue on today. So as I mentioned on Mondays, if you've not seen the show on Monday before, we hit the market from three directions. We start with the macro point of view, then we go through sectors, then we go through individual stocks. And this sort of overall mirrors the process that I go through starting every Thursday as I get ready for a note to clients Friday morning. It goes through parts of the weekend. I try to be as limited as possible on the weekend, but then Sunday into Monday, look at the S&P 500 charts, and this show is a way to sort of summarize some of the things that I noticed, key takeaways from that review of all the charts. So starting at the macro perspective, today you have the S&P pushing higher. It was really a choppy day, and just after lunch, actually hitting a swing low, hitting a low for the day, really starting to be toward the lower end of Friday's session, but really turned around and pushed higher through the course of the day. Now, this was sort of a push and pull between growth working and value not working for most of the day. In the end, it was sort of a growth takes over and pushes higher, and you saw the improvement into the end. The Dow actually finishing down for the day around 0.4%. The NASDAQ 100 up 1.25%. We're going to look at a chart of the FAANG stocks here in a moment, but overall, if you're looking for strength, it's hard to find a better example than the FAANG Plus index and pretty much any of the member stocks in there. If you look at mid caps and small caps, it's worth noting. What are signs of concern? What are chinks in the armor? For me, the lack of confirmation from mid caps and small caps. Now, granted, they tend to be a little more exposed to some of those cyclical sectors like financials and industrials or materials than the large cap index. Having said that, though, again, you have a lack of confirmation. The cumulative advanced decline lines, by the way, as of Friday's close, did not make a new high for any of those indexes. The mid-cap was really close, but I don't think it did. As of today, I would be surprised if those other cap tiers were able to confirm a new high. So you have the market moving higher, but the advanced decline lines are not confirming that new high from last week. Also on Friday, we talked only 3 of the 11 S&P sectors made new all-time highs last week. 2 of those back in the driver's seat today, communication services and technology. I don't want to jump the gun. We'll get back to sectors here in a moment. Yields back down. So on Friday, this is a big change. If you look at the 2-day preview chart here on our dashboard, Friday was a sell-off in bonds. You saw the rally in the 10-year yield ending the day around 154. Today, it was the complete opposite. You had bonds popping up pretty nicely with the TLT up 1% today. You saw interest rates come down with the 10-year yield settling in around 148 or so. So again, in general, if you want to know what's going to work and what isn't, the chart of the 10-year can certainly give you the headwind versus tailwind of what rates are going to do and what that means for growth versus value. And so far, it's pretty much followed the playbook for the most part, right? The dollar index was actually flat today. So there have been that stronger dollar has certainly fueled U.S. outperformance of non-U.S. stocks. If you look a little deeper, you see emerging markets performing better than developed markets, but overall, the dollar flat today, so not really changing much in that picture. Commodities, gold was basically flat for the day. This is after a sell-off on Friday, a little rebound into the close. Today was really just choppy action for most of the commodity complex. Not everywhere there. So oil prices were down, and that's why energy was down as the worst sector. Interesting move in cryptocurrencies. So you sort of have the long Ethereum, short Bitcoin trade working just fine. This was I saw Jim Cramer mentioning Ethereum as a better play, and certainly the market expressing that based on the movements today. The speculation was something like Bitcoin overall. I don't think, as far as I'm concerned, it's not about the importance or the value of blockchain technology. I think that's unquestionable. The impact that will have in many places is undeniable. I think the question is where do you actually profit from that thesis, right? And if you're thinking just by Bitcoin and that's going to rise because blockchain is a really good technology, I think that might be shortchanging the investability of some of these other coins. And I wouldn't be surprised if you start to get some dispersion here. At some point, a certain point, it's a macro call. It's do you want to own cryptocurrencies? But at some point, as a market starts to mature, I think it's a little more about where do you want to be? You could argue you're seeing that in equities right now, right? It's not as much do I want to own stocks or not? It's really been more about what stocks do I want to own, even in a sector like healthcare, right? There are stocks that work very well and stocks that are not working as well. And it's all about identifying those opportunities. I think one of the big benefits, or arguably the most important benefit, as an individual investor, as an advisor, we have flexibility to determine where you're going to put assets. The benefit of momentum investing, of looking at charts, is that you can focus on where the opportunities are. Having said that, looking at a chart of the S&P, another new all-time high, another all-time closing high at 4290, plus a little bit of change. Again, the trend has been positive. Still, as of today, you're not confirming a momentum breakout. You're still making lower momentum on each new high. This week could change, though. And if you look at this January, February, March period, you had a very similar pattern of a momentum divergence, higher highs, January, February, March, lower peaks in RSI. That changed at the end of March, beginning of April, when you made new all-time highs on improving momentum. I am keenly looking right now because you have a very similar 3-month period, April, May, June, higher prices, lower momentum, which is a momentum divergence. If that breaks this week, I think you have to really just assume that prices are going higher. I think that's a reasonable assumption now because the prices have gone up. So I don't mind owning stocks or continuing to own stocks that are going higher. And I would, when I think about the questionability of the upturn, and I talk about limited upside, it tells me less to sell things that have been working. I would never sell things or want to get rid of something that is clearly working and clearly going higher. It tells me to be looking for when that pattern breaks. We've not seen that yet on the S&P, as we keep seeing higher highs and higher lows, but that's the that is the game. It's interesting as we get into the sectors and get into the individual stocks, you'll find some charts that are no longer making higher highs and higher lows. And that's where I would argue you need to be focusing some of your attention and see if it's still worth your investment or worth your capital to follow some of those charts that are no longer outperforming. That is our top-down macro discussion. Again, a lot of movements on here. In general, this sort of week tends to be a quieter week, the week before a long holiday weekend. But however, you also have the end of the quarter, the end of the second quarter, the end of the month. So that usually is a busier time. So I wouldn't be surprised if you get some good action Monday, Tuesday, Wednesday at the end of the quarter, and then things start to quiet down going into the long holiday weekend. Let's continue on with our discussion of sectors. We'll start with the RRG. It was so fun to have Julius de Kempener on the show last week. He does a fantastic job, and I've known Julius for years and have followed his work with the RRG, even in earlier forms as he was creating that methodology. And I've just found it such a beautiful way of visualizing sector rotation. We talked about this weekly RRG when he was on the show. I think that was on Thursday's show. But basically, worth noting that energy, while weak today, if you look at the weekly RRG, which is the long-term sort of rotation of sectors around the benchmark, energy is the strongest, right? And you can tell that by the fact that it is furthest to the right. Furthest to the right means the strongest relative performance based on this longer-term view. And heading northeast is the direction of improvement. That's a trend that is not just outperforming, but it's actually the momentum is increasing as well. So something in the weakening quadrant that is sort of rotating clockwise far to the right of the y-axis is actually a pretty decent chart. It's interesting to see energy, looking so well here. Now today, obviously, you sold off. We'll try to get to some of the charts on there, but a lot of the top 10 stocks in our scooter rankings, things like NOV and Devon Energy, pulling back pretty good today. But overall, the trend's still in good shape. Real estate has been a fairly consistent outperformer. You can see the relative strength is coming down a little bit on the RRG, but still very, very strong. And financials are third. So you have the cyclical leadership and a bit of defensive leadership. Communication services is the only other sector that's actually in the leading quadrant right now. I think that's worth noting, especially as you have stocks like Facebook, some of the FAANG stocks, others in that communication services sector, it's really pushing to the upside. Facebook, obviously, some news on regulatory impact to their business, but overall the charts doing very well. What scores very poorly on the weekly RRG is consumer discretionary. It is the weakest of the 11 sectors, and it's telling you as a sector allocation to be wary of things that are down in that area. Southwest and heading southwest is not a strong direction on the RRG. Now let's look a little bit at the shorter term, the tactical movement in some of these sectors. As I mentioned at the end of last week's show, or last week on the show, and I forget what day we talked about this, but as of the Friday close, only 3 of the 11 S&P sectors had actually made a new high last week. So while the S&P making a new all-time high, the Nasdaq making a new all-time high, only 3 of the 11 sectors made a new all-time high. If you didn't catch it, can you guess what they are? Now, the answer is on the screen in front of you. So look at the charts. Upper left is number 1, communication services, certainly pushing to a new high, improving again today, very much in a position of strength. Number 2 is technology here, sort of mid-right, up another 1% today, leading the market higher, along with comm services, making a new all-time high today, but also pushing higher next week. The third one, maybe a bit of a surprise, which is healthcare, right? So this is actually one where the trend has been very positive. And if you ignore the relative strength and just look at the trend, pretty decent chart. You can see higher highs and higher lows with some pullbacks here, like in the first quarter. You made a pretty decent bottom there in the beginning of March, but overall making new highs above the 50-day moving average, not bad. This is the challenge for healthcare, has been the relative strength that's been so underwhelming. Healthcare really underperformed. After spiking higher into a peak in April, really underperformed for the next 12 months until early April of this year. But if you look at the last couple of months, it's really been more sideways. Now, that's a bit of a, what do I want to say? It sort of confuses things a little bit. That's not 100% clear, only because certain stocks within healthcare have done very, very well. We'll hit a couple of those here in our next segment on shifting stocks. There are pockets of healthcare that have done very well. The challenge is some of the larger names that are biggest weights, things like Johnson & Johnson and others, have not been performing as well. And so overall, the sector's netting out to sort of a wash. It's sort of a flat relative chart, but you can see that the sector as a whole is improving. I would argue some of the areas within there, we've highlighted medical equipment, supplies, some of the pharma names like Moderna and others that have done very, very well. And so again, as always, I think the best opportunity you have is focus on the charts that are working, lean into those, lean away from the charts that are not working. And in general, that's a decent way to outperform over the long term. So healthcare as a whole doing okay, and that was again only one of the 3 sectors that made a new high last week. So is it, from a sector breadth perspective, is it a challenge that Only 3 of the 11 sectors made new all-time highs. Is that a cause for concern? I don't know, not necessarily. And if you want examples, we can always look back to previous years. 2019 jumps out at me, although I don't have the chart in front of me, where that was sort of like the FAANG stock, the glory days of the FAANG stocks. If we haven't remade those now today, the market going higher, a lot of stocks not necessarily participating, but it was really that smaller group. It was the FAANG stocks really pushing the market higher, and that was enough to push a lot of things up. A lot of things sort of were dragged along with the FAANG stocks, and we're seeing a similar environment here in some ways, where the strongest charts are in a relative small number of sectors. You have others that are actually more struggling, especially the cyclical sectors like industrials and materials. Now, if you look at some of those sectors that are not working as much, and we'll look at materials, for example, this would be the concern for me. We don't have time to look at all of the charts in this sector, but this is a sector that was making a new all-time high about a month and a half ago, and even before that, right? March, April, May, making new all-time highs. Beautiful chart, making new relative high in May. That was quite impressive. We talked about that at that point. And then look at what's happened from there. You have an accumulation phase, a consolidation phase, a breakdown phase, or a distribution phase. Breaking below the 50-day moving average is significant. Other times when it's broken below the 50-day moving average, it's been 1 or 2 sessions and then you pop right back up. That has actually not happened. Now you're sort of settling in and retrenching, if you will. We're sort of digging in our heels below the 50-day moving average. That's what some of these charts look like. And so the question with these is, how do you manage that risk? At this point, given what you've seen over the last week, you've now made a new swing low by undercutting the low from May. You now arguably have made a new lower high, right? And I think it depends on how things resolve here, but potentially you're now in a new downtrend on the tactical front, where you're making lower highs and lower lows. You're making relative strength lows, made a 3-month relative low again today. So I would be concerned holding some of those cyclical sectors to determine how long you'd want to hold on to them before you decide to back off a little bit. The question then, of course, is going to be when you get in. And for me, I look for patterns of distribution and accumulation. I would say a sector like materials, while in the long term, I think there's very much opportunity there at this point. I think you wait for some sign of accumulation, a higher low, bottoming out above 80 on the next pullback would be key. We need to take a quick break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we make sense of things together using the power of StockCharts. Just a couple quick housekeeping items before we get to our shifting stock segment. Number one, we're actually in the process of transitioning back to broadcasting the show live again at 4 p.m. Eastern. Our plan is to do that next Tuesday, right after the 4th of July holiday. We hope you're able to join us for the new time frame. So we're moving from 6 p.m. Eastern back to 4 p.m. Eastern. We're actually this week testing a lot of new capabilities. So thanks for sticking with us as we get things set up for that new time and that new slot, but we'll be excited to get this show back to live. Also, as a reminder, go to stockchartstv.com, use your email, set up a free account. You can start watching all of our content from our website, also from all your mobile devices. Just go to the App Store and search for StockCharts TV on demand. Finally, shoot us your questions. We'll do another mailbag segment a couple times this week, hopefully. We'll definitely on Tuesday's show. You can email us at thefinalbar@stockcharts.com. No question is out of bounds. We'll do our best to point you in the right direction. Our next segment is called Shifting Stocks. So now we've talked about the big picture, talked about the resilience of stocks, the S&P, the NASDAQ moving to all-time highs, really driven by growth last week into continuing today. We talked about sector rotation, how only 3 of the 11 S&P sectors made a new all-time high last week, but how that's actually okay. There are plenty of times when the market can move up, and those sectors like communication services and technology, there's a lot of cap in those sectors and plenty of opportunity to push the market higher, driven by those sectors. Finally, we go to shifting stocks, and this is really what happens when I look at a bunch of charts over the weekend is I come up with a lot of just random things that jump out at me. I'll try to highlight some of those. We finished in our discussion of, or during our discussion about sectors, we talked about the healthcare sector, and I'll show you an example of why the sector overall is relatively flat on a relative basis. Chart one is Moderna. This is obviously, related to the coronavirus. You have an incredible run on this stock. And again, I'm often asked with a chart like this, is it too late to participate? Something that's already had a pretty good run. You can see on a relative basis, it's outperformed for so long. And, in general, I rarely would avoid something like that just because of that reason. And I can show you plenty of charts that were up a lot before they were up a lot. And what I mean is, I learned earlier in my career not to be afraid of the new highs list, because that shows you where there's strength. And I've worked with institutions that follow trends like that as long as they can. And so is there an opportunity for Moderna to go up much further than this? Absolutely. Do I know what's going to happen? Of course not. But in general, given the choice, I would much rather follow charts that are working than follow charts that are not. When I'm looking at a chart of Moderna, I'm seeing a consistent pattern of higher highs and higher lows. I love the basing pattern that you saw here at the beginning of the year. This resistance just below 200, there's around 180, 190, and you can see we broke above and tested that from above. In general, that is a decent pattern. That's a consistent pattern that just tends to work. You have clear risk laid out on the chart just below 200. The lows from the last couple of weeks, the 50-day moving average right around at that breakout level. I would never feel that bad about taking a shot at a chart like that. What looks less attractive? Something like Johnson & Johnson. On a price basis, not horrible, right? So it's not far off of long-term highs. You can see the spike higher into January, the retest of that level in May. So while Moderna has actually been able to push above all-time highs, Johnson & Johnson has not. And that's why it's a little less attractive. But more importantly is the relative strength. While this chart looks like it's going higher, and it is, on a relative basis, though, the market has gone up so much more than that. And so that's the benefit of having relative strength on a chart like this, making new, multi-year relative lows last week. It shows you really the weakness within that part of the sector. So just within one group, pharmaceuticals within healthcare, you have a chart that is doing particularly well and breaking out on a relative basis, and a chart that's doing poorly. That's why the healthcare sector overall has been difficult to outperform. But I think there are pockets within any of the sectors that are doing fine. To prove that, consumer staples is arguably one of the worst, if not the worst, sectors on a relative basis. It's just been a difficult sector to be overall, but you have a chart like Costco that's actually working beautifully, right? This nice basing pattern. And when I talk about a basing pattern, that's basically when a chart rallies, you then hit a resistance level and you sort of back and fill some of the previous range. But then the base is sort of this resistance level that you retest, and then you break out. And this is called a base breakout, where you break above that resistance and push higher. And that's key, because at this point, it just tells you that we've gotten back to the previous resistance. Investors that bought here in December of 2020 are now made whole if they held on, and they're just back to flat. You really need a new influx of buying power to push price higher, right? You need additional demand or less supply or something to reset things, to recalibrate things and break out of this equilibrium. And that's what arguably you've seen with Costco, with the stock going to new highs. So even within consumer staples, I think there are charts that are fairly decent. Now let's continue on. Obviously, the strength today in the FAANG stocks. We're looking at the New York FAANG Plus Index. We can talk about the S&P going to new highs, the Nasdaq going to new highs. I would argue, if you want to understand the leadership and growth and understand the current market environment, this might be the chart to do it. You can see how the New York FAANG Plus Index was threatening a new swing low about 6 weeks ago, and now is threatening a new swing high, threatening to break out of this base. You can see the relative performance has been much more impressive. Now, this is at a time when stocks like Facebook have already been making new highs during this phase, but it's things like Apple that were in more of a consolidation range, right? Sort of a consolidation pattern, a symmetrical triangle pattern, resolving that to the upside. It's now threatening this resistance, which I think is a key line in the sand around 135, which we just touched today. I'll be very interested to see if we push above it. The signs that I'm looking at certainly point to that being a high probability. Netflix breaking above a trend line, or just testing a trend line from highs in recent months. You can see Microsoft a little more like Facebook, sort of blowing onto new highs. So you have half of these stocks, Alphabet, Microsoft, Facebook, just already going to new highs. The rest of these that have been the laggards within the FAANG trade are all starting to break above trend lines using the previous highs. Apple, Netflix, and then Amazon really is a little different. It's sort of in the middle of the range and pulling back from those all-time highs. So overall, that group of 6 stocks has done very well. If you add another N in there and put NVIDIA, you can draw on the strength of semiconductors, and you can see why the growth trade is working so well. Obviously, the group technology within semiconductors within technology, not all of them look exactly the same. It is not a 100% homogeneous group. However, NVIDIA certainly a leader there, becoming extremely overbought today with an RSI above 80. What that means to me is that extreme overbought is sort of what we would call the good overbought. It means the momentum is so strong, you most likely have at least one push higher before a pullback. But overall, it's telling you there's extreme upside momentum. Within semiconductors, you have other charts like Intel, which was up today, granted, to 2.8%, but still overall, you can see the very difference between Intel versus NVIDIA, same group, but very different technical profiles. Intel has been really range bound for multiple years here. I don't see a lot to enjoy from that chart. Could it go higher along with other semiconductors? Absolutely. There's certainly no reason why it can't. When I'm looking at charts with attractive setups and attractive trends, NVIDIA far outweighs them. Price highs, relative highs, extremely overbought. We only have a few more minutes, actually like 1 minute, if that. So I'll just show you, obviously, Tesla, the ARK Innovation Fund, the Clean Energy Fund, ICLN is an ETF. These are all rotating back above moving average resistance. Enphase is breaking above resistance from April. So the growth trade is certainly working. And again, could that end tomorrow? Absolutely. But the strength I'm seeing in the charts today doesn't just disappear. It shows you that there's strength. There's money going into those charts, and it's impressive. Just briefly, very, very briefly, what's not working today? It's cruise lines. And if you look at the chart of transports, it's not that impressive. Again, I've seen times where growth works and transports don't, and the market does just fine. So I don't think it's a huge worry right now, but the traditional Dow theory is fairly underwhelming because things like cruise lines and airlines are not doing very well. Cruise lines all feeling the pain today, coming off of resistance and now threatening to make new swing lows. And then the other areas of weakness today really within energy. And again, charts like Halliburton are not broken. They're not horrible. They're just not going up, especially on a relative basis. And again, I'd much rather lean into what's working. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. We finished our last segment talking about the FANG Plus index. And again, this is the chart that I'm watching to really demonstrate the strength today. You can look at the NASDAQ making new highs, totally fair. The S&P making new highs, totally fair. But why is that happening? This would be the chart I would go to. And so that's the one I'm going to want to follow. See if this FANG Plus index continues to push higher. This encapsulates that growth trade, the new economy trade, whatever it is that you want to call it, sort of in one index. And that index is threatening new all-time highs to push above the resistance in February, threatening to become extremely overbought, which is overall fairly constructive. Chart number 2 is growth over value. We've talked at times in the last couple of months about the resilience or the strength in value. Value has underperformed for so long. All of a sudden, you saw value really strengthen here from the fourth quarter, really the end of the third quarter of last year through the first quarter of this year. It was about value over growth and some of those cyclical sectors doing so well. All of a sudden, that's changing, right? And that ratio has bottomed out and arguably now broken out above the April swing high. So overall, it's showing you that the strength is in growth. And any comparison I have looking at pure growth or pure value, growth versus value, whatever it is, all very similar to this chart. You could also look at something like the XLK over the XLF or something like that. So find a very similar pattern in that ratio, and it's showing you the strength and growth over value. Finally, the mid-cap index, and I think it's just worth noting, not everything is going to new all-time highs, and this is one of those challenging periods. I don't think this is one of those just own everything and it works. There are periods when it's a macro call and you just want to be all in or all out. I don't think this is one of those times. And we've been talking about that actually for a while. I don't think it's about just owning stocks and having that be a good necessarily call. Because if you're owning the mid-cap index, you're not feeling probably great about the fact that you've been in a downtrend here for the last 2 months while the market itself is actually going higher. So I think, quote unquote, the market can mean a lot of things. You need to look at the individual stocks, the groups, the sectors, the styles, and make sure you're into things that are working. The mid-cap index is actually threatening a new, multi-month 4 or 5 month relative low. Stocks or the index is actually testing a 50-day moving average from below. The RSI has remained below 60 for the last month and a half or so. So overall, this is more of a distribution phase. I'd be very keen to see if you can establish a higher low. That would be first stage of recovery. Also look at those cumulative advanced decline lines. Folks, that's our show for today. Thank you so much for joining us every weekday after the close for the final bar. Also, as a reminder, we'll do a mailbag segment on Tuesday's show. Shoot us your questions, won't you? The final bar at StockCharts.com is our email. From everyone here at StockCharts TV, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.